Imagine being able to pay for your child's college education with money that grows quietly in the background and gets special tax advantages most people don't even know about. Sounds almost too good to be true, right? Well, that's exactly what a 529 plan promises. But here's the catch. Most families don't fully understand how it works, and they end up missing out on thousands of dollars in benefits. By the end of this video, you'll know exactly how a 529 plan really works, the smart ways to use it, and even a few surprising pitfalls that could cost you. So stay with me, because the way you handle this could literally change how much college ends up costing your family. Number 1. What is a 529 plan really? At its core, a 529 plan is like a special savings account created just for education expenses. The name 529 comes from Section 529 of the Internal Revenue Code. Think of it as a piggy bank with superpowers. You put money in, it grows over time, and when you take it out for education expenses, you don't pay federal taxes on the growth. Here's a quick example. Imagine you invest $10,000 into a 529 plan when your child is a baby. Over 18 years, with steady growth, that could turn into $25,000. Normally, you'd owe taxes on the $15,000 gain. But with a 529 plan, if that money goes to education expenses, you pay zero federal taxes on the growth. That's the basic promise: tax-free growth and tax-free withdrawals when used for qualified education costs. Number 2. What counts as qualified education expenses? Now, here's where people get tripped up. You can't just pull money out for anything. Qualified education expenses include tuition, fees, books, supplies, and even room and board if the student is at least half-time. Let's make it real. Say your daughter goes to a university and tuition costs $12,000 a year. Add another $4,000 for books and living expenses. All of that can be covered by your 529 plan. And it's not just college. Since 2017, you can use up to $10,000 per year for K through 12 private school tuition. And as of recent updates, you can even use some 529 funds for student loan repayments, up to $10,000 lifetime per borrower. But careful, buying a laptop for Netflix binges or paying for spring break trips won't count. If you use it on non-qualified expenses, you'll pay taxes on the earnings plus a 10% penalty. Number 3. Who can open a 529 plan and who controls it? Here's a common question. Do I have to be a parent to open a 529 plan? The answer is no. Anyone, parent, grandparent, relative, even a family friend, can open one. The person who opens the account is called the account owner, and they control it. They decide when to put money in, how it's invested, and when to take money out. The student is the beneficiary. Here's the powerful part. If the child you set it up for doesn't use it, you can change the beneficiary to another family member. So if your son skips college but your daughter goes, you can simply switch the plan to her. That flexibility makes it less risky than people think. It's not use it or lose it. Number 4. How does the money grow inside a 529 plan? Inside a 529 plan, your money doesn't just sit there. It's invested, usually in mutual funds, ETFs, or age-based portfolios that adjust as the child gets older. For example, if you start when your child is a newborn, the plan might put your money into stocks for higher growth. As your child gets closer to college, it shifts more into bonds and safer investments to protect the money. This means your growth depends on the market, just like a retirement account. Some states even let you choose your own investments. Think of it like planting a tree. The earlier you plant it, the bigger it grows. Someone who starts saving when their child is a baby could have tens of thousands more by college than someone who starts in high school. Number 5. State tax benefits you don't want to miss? Here's a hidden gem most people overlook. On top of the federal tax benefits, many states give you a tax deduction or credit for contributing to a 529 plan. For instance, if you live in New York, you can deduct up to $5,000 per year in contributions from your state taxes or $10,000 if you're married filing jointly. It's like the state rewarding you for saving for college. Not every state offers this, but most do. And some states even let you claim the deduction no matter which state's 529 plan you use. That's basically free money just for doing the right thing. Number 6. Common myths and mistakes about 529 plans. Here's where many families go wrong. First, they think a 529 plan locks their money forever. Not true. You can withdraw at any time. You'll just face taxes and penalties if it's not for education. Second, people think 529 plans ruin financial aid eligibility. The truth is, yes, they count as an asset, but in most cases, it only reduces aid by a small percentage. For example, a $10,000 account might reduce need-based aid by around $500. That's much better than missing out on thousands in tax-free growth. Another myth is that you have to invest in your own state's plan. Actually, you can shop around. Some states have lower fees or better investment options. Number 7. How much should you save in a 529 plan? This is the big question every parent asks. The answer depends on your goals. Do you want to cover all of college or just give your child a head start? As a rule of thumb, experts often suggest aiming to save about 1/3 of expected college costs in a 529. The rest can come from income, scholarships, or student loans. For example, if you expect college to cost $100,000, saving around $33,000 in a 529 might be a reasonable target. But don't let the numbers scare you. Even small amounts add up over time. Contributing just $100 a month from birth could grow to more than $40,000 by college with steady returns. Number 8. What if your child doesn't go to college? This is one of the biggest worries parents have. What if you save for years and your child decides not to go to college? Here's the good news. You have options. You can transfer the account to another child, a cousin, even yourself if you want to go back to school. You can also save it for future grandchildren. And starting in 2024, there's another exciting option. You can roll over some unused 529 money into a Roth IRA for the beneficiary, up to certain limits. That means the money can still be used for their future, just in a different way. So you're not really losing the money, it just shifts purpose. Number 9. Real-life examples that bring it all together. Let's look at two families. Family A saves $200 a month in a 529 plan from the time their child is born. By college, they've contributed about $43,000, and the account has grown to around $70,000. That money covers a huge chunk of tuition, tax-free. Family B doesn't start saving until the child is 14. They put in the same $200 a month for 4 years, less than $10,000 total. By the time college starts, the account hasn't had time to grow much. They're left relying on loans. The difference? Starting early and using the 529 plan as it's designed. Number 10. So, is a 529 plan worth it? The answer for most families is yes. It gives you tax advantages, investment growth, and flexibility. It's not perfect, and it won't cover every dollar of college, but it's one of the best tools we have to fight rising education costs. Think about it. College costs have more than tripled since the 1980s, and the average student loan balance today is over $37,000. Using a 529 plan could mean your child starts adult life without that burden. Number 11. How to open a 529 plan step by step. Opening a 529 plan is actually much easier than most people think. First, pick which state's plan you want. You can choose your home state or shop around for one with lower fees or better investment options. Second, go to the plan's website. Most allow you to open an account completely online in about 15 minutes. Third, enter your personal information as the account owner, then add the beneficiaries' information, usually your child's name and social security number. Finally, choose your investment option and set up your contribution. You can link your bank account to automatically invest every month. That's it. It's no harder than opening a regular savings account. Number 12. Can you change investment options later? Many beginners worry they'll pick the wrong investment option and be stuck forever. The truth is, 529 plans let you change your investment choices up to twice per year. So if you start with an aggressive portfolio, but later decide to be more conservative, you can switch. And if the beneficiary changes, for example, from a 2-year community college to a 4-year university, you can adjust the plan to match. This flexibility gives you room to adapt as life changes. Number 13. What fees should you watch out for? Every 529 plan has some costs, but they can vary widely. Some plans charge annual account maintenance fees, though many waive them if you set up automatic deposits. The biggest cost usually comes from the investment expense ratios, which are the fees charged by the mutual funds or ETFs inside the plan. Here's the catch. A high fee, like 1% per year, can eat away thousands of dollars over time, compared to a low fee, like 0.1%. That's why comparing fees between state plans is just as important as looking at tax benefits. Number 14. What happens if the beneficiary gets a scholarship? This is a great what if question parents ask all the time. If your child gets a scholarship, you can withdraw the same amount from the 529 plan without paying the 10% penalty. You would still owe taxes on the earnings portion, but not the extra penalty. For example, if your child gets a $5,000 scholarship, you can pull out $5,000 from the 529 without the penalty. That way, you're not punished for your child being successful. Number 15. Can grandparents use 529 plans too? Absolutely. In fact, 529 plans can be a powerful estate planning tool for grandparents. When grandparents contribute, the money immediately leaves their taxable estate, which can reduce estate taxes later. At the same time, they still control the account and decide how it's used. And here's another benefit. Some new financial aid rules are making it easier for grandparents to contribute without hurting the student's aid eligibility. So it's a win-win for families who want to pass on wealth while helping with education costs. Number 16. Are there contribution limits you need to know about? Yes, and this is where it gets interesting. Technically, the IRS doesn't set a strict annual contribution limit for 529 plans, but contributions are considered gifts for tax purposes. That means in 2025, you can contribute up to $18,000 per year per child without triggering gift taxes, or $36,000 for married couples. There's also a special rule called superfunding. It lets you contribute up to 5 years' worth of gifts at once, so as much as $90,000 per child or $180,000 for couples. That can turbocharge growth if you have the resources to front-load the account. Number 17. Are all 529 plans the same? Not at all. Each state runs its own version, and the differences can be huge. Some states offer only a few basic investment choices, while others have a wide menu of funds. Some charge high fees, while others are very low cost. And only certain states give you that extra state tax deduction or credit. That's why smart parents often research and compare multiple states before choosing a plan, even if it's outside their home state. Now you know the truth about how a 529 plan really works. It's not just a savings account. It's a strategy, a way to outsmart rising tuition and give your child a head start in life. So here's my question for you. If you had the choice today, would you start saving in a 529 plan for education, or would you risk facing the full cost of college later?